COMEX, the exchange that sets the price of silver for the entire world, is running out of metal. And the math says it hits zero by March 6th. I'm not being dramatic. I'm reading you the data straight from COMEX warehouse reports. 5 months ago, there were 200 million ounces of deliverable silver sitting in the COMEX vaults. As of February 19th, that number is 88.79 million. 111 million ounces gone, drained out of the system at a rate of 20 million ounces per month. And the drain is not slowing down, it's accelerating. At the same time, the March to May contract roll is failing. In simple terms, futures contracts have expiration dates. When a contract approaches expiry, most traders roll it forward into the next month. They don't want the metal, they're just trading paper. But right now, the contracts in March are not rolling into May fast enough. The exchange needs to move roughly 30 million ounces worth of contracts per day. Yesterday they moved 15, half the required pace, which means when first notice day arrives on February 27th, 5 trading days from now, there could be a massive amount of contracts still standing in March, demanding real silver from a vault that's been losing 20 million ounces every single month. And here's the part that took my breath away. While I was going through this data today, a major silver miner released their earnings. And their numbers confirm something that I think changes this entire story. The real price of silver is not what your screen says. It's much higher. And now 2 completely different mining companies from 2 different countries have proved it, with audited numbers filed with regulators. By the end of this video, you're going to understand exactly how COMEX got here, why the vault trajectory points to zero, what the failing roll means for February 27th, how 2 silver miners are both getting $69 when the market says $55, why the US government just said pricing is the key, and 5 specific signals to watch over the next 5 days. Let me start with the vault chart, because once you see this, everything else makes sense. I'm looking at the COMEX Depository Warehouse Registered Silver Stocks chart. Registered means deliverable. This is the silver that can actually be handed over when someone demands delivery on a futures contract. And it's collapsing. In September 2025, registered silver was 200 million ounces. October, it started falling. November, faster. December, steeper. January, much steeper. And in February, it's falling off a cliff. The current number is 88.79 million ounces. That is a decline of 111 million ounces in 5.5 months. An average of 20 million ounces per month leaving the registered category. Let me put 20 million ounces per month in perspective for you. Global silver mine production is roughly 820 million ounces per year. That works out to about 68 million ounces per month. So COMEX is losing the equivalent of about 30% of the world's monthly mine production from its deliverable stockpile. Every single month. For 5.5 months straight. And if you look at the chart closely, the decline is not linear. It's curving downward, getting steeper. From August through November, the drop was gradual. Then December and January accelerated. And the February numbers are the worst yet. This is not a steady drain. This is an accelerating drain. Now, some people will say there's eligible silver in the vaults too. Eligible means the silver is in the vault, but not currently available for delivery. The owner hasn't made it available. And yes, theoretically that silver could be transferred into the registered category. But here's what the data shows. The registered decline of 20 million ounces per month is the net number. It already includes any transfers from eligible into registered. After all the inflows, after all the transfers, the system is still losing 20 million ounces per month. The eligible transfers are not enough. The system is net negative. And it's getting worse. And there's something else happening that almost nobody is covering. As the gap between the Shanghai physical silver price and the COMEX paper price widened to $18 per ounce when silver ran past 120, silver started physically leaving New York and shipping to China to capture the premium. So COMEX isn't just losing silver to deliveries, it's losing silver to international arbitrage. Metal is flowing east because the price is higher there, and once it leaves, it doesn't come back. Now, let me show you the delivery data that makes this even worse. In February 2026, the delivery rate on COMEX Silver was 98%. Let me explain what that means. In a normal futures market, when contracts approach expiration, most people roll forward or close for cash. Typically, 5 to 20% actually stand for delivery and take the metal. In February, 98% stood for delivery. Virtually everyone wanted their silver. That is not a futures market. That is a physical allocation system. January was even more alarming in a different way. January is normally a quiet month, minor delivery month. In January 2026, COMEX delivered 49.4 million ounces of silver. That's 4 times the January 2025 level, 7 times January 2024. A minor month turned into a major delivery event. Why? Because traders are front-running March. They don't trust that the silver will be available in March, so they're grabbing it early. in January and February, while they still can. And zoom out even further. Total COMEX Silver deliveries in 2025 were 474 million ounces. In 2024, it was 202 million, more than double. Every single month of 2025 had higher deliveries than the same month in 2024. 12 months in a row. This is a systematic shift from paper trading to physical metal demands, and the vaults were never built to handle this volume. Welcome to the hidden economy. If you're new here, subscribe and hit that like button. It really helps the algorithm and keeps me motivated. Thank you. And now let me show you what's happening with the March roll, because this is where the March 6th number comes from. I'm looking at the COMEX Silver Futures open interest data from February 19th. March 2026, open interest is 53,952 contracts. Each contract is 5,000 ounces. So that's 269.76 million ounces of silver still committed to March delivery. Yesterday, March open interest dropped by 3,111 contracts. Sounds like progress, right? Contracts rolling out of March. But May open interest only went up by 2,418. That means roughly 700 contracts vanished. They didn't roll to May. They either closed entirely or they're positioning to stand for delivery. And the pace is way too slow. To clear March open interest before first notice day, the roll needs to move roughly 6,000 contracts per day. 30 million ounces worth. Yesterday was about 3,000, half speed. At this rate, when February 27th arrives, there will still be tens of thousands of contracts standing in March. And every single one of those contracts is a potential demand for 5,000 ounces of real silver, from a vault that has 88 million ounces and is losing metal every day. Now there's something else in the data that I almost missed. Silver is in backwardation. March futures are trading at 77.60, May futures at 78.20, silver right now is around $78, gold is at 5,000, and the near-month contract is priced almost the same as the far month. In a normal healthy market, later delivery months cost more because of storage and insurance costs. When the near month costs the same or more than the far month, it means the market is desperate for silver right now, not later, now. Backwardation is one of the loudest alarm bells in commodity markets, and silver is ringing it. Let me walk you through the daily registered numbers so you can see the progression. February 9th, 102 million ounces. February 10th, 101 million. February 11th, 98 million. February 12th, 93 million. That's a 9 million ounce drop in 3 days. Then February 13th, 92.9. February 17th, 92.1. February 19th, 88.79. Every single day. Lower, without exception. There has not been a single day where registered silver increased. Now here's the math. If you extend the current drainage rate forward, and you account for the contracts that are not rolling out of March, COMEX registered silver approaches zero around March 6th. That is 7 trading days after first notice day. The vault runs out of deliverable metal. Will it actually hit zero? Probably not. Because before it gets there, the exchange will intervene. They'll raise margin requirements. They'll incentivize cash settlement. They'll change the rules if they have to. We saw this in 1980 when they changed COMEX rules to liquidation only to stop the Hunt brothers. They literally banned people from buying silver futures. You could only sell. We saw it on January 30th this year when silver was crashed 46% in a single session to wipe out call options and scare people into selling. They will do whatever it takes to prevent a formal default. But I want you to notice something. The interventions are getting bigger. In 1980, they changed the rules for one commodity. In January 2026, they crashed the price of one of the most important industrial metals on Earth by almost half in 24 hours. What does the next intervention look like? Higher margin requirements that force smaller players out, cash settlement at a premium that admits they can't deliver, emergency position limits. I don't know exactly what form it takes, but I know it's coming because the math requires it. And here's the key insight. The intervention is the admission. Every margin hike, every crash, every rule change tells the world the same thing. COMEX cannot handle real delivery demand, and every time they intervene, physical buyers lose more trust in the exchange and go directly to the mines instead, which is exactly what Hecla and First Majestic's numbers prove is already happening. The interventions don't fix the problem, they accelerate it. Which brings me to the second story, and this one proves exactly what I just described. First Majestic Silver, one of the largest primary silver producers in the world, released their fourth quarter and full year 2025 results today. This is a company that operates mines in Mexico. They produced 4.2 million ounces of silver in Q4 alone, up 77% year over year. Full year production, 15.4 million ounces. Revenue for the quarter was $463.9 million, up 169%. Full year revenue, $1.257 billion. They went from a loss last year to net income of $211 million. And they ended the year with $937 million in cash, tripled from $308 million. Record quarter, record year, in every single category. But here's the number, the one that matters. The average COMEX Silver price during Q4 2025 was $55.20. That's the benchmark. What the exchange says silver was worth. First Majestic's average realized silver price was $69.74, 26% higher than the market price. Now, earlier this week, Hecla Mining, the largest silver producer in North America, reported their numbers too. Hecla's average realized price was $69.28, against a benchmark of $54.83, a 30% premium. I broke this down in detail in my previous video, link in the description if you want the full Hecla analysis. 2 mining companies, 2 different countries, 2 different benchmarks, and virtually the same realized price, $69. I want you to sit with that. The market says 54, it says 55, depending on which average, but both miners got 69. Both of them, independently, filed with the SEC, audited, on the record. That is the real price of silver. What you see on your screen is the paper price, the COMEX fiction. The real price is what someone actually pays to get metal in their hands, and right now industrial buyers are paying that price directly to the mines, bypassing the exchange entirely, because they need the metal and they don't trust COMEX to deliver it. Now, I want to make sure everyone understands what a 26 to 30% premium actually means, because this isn't just a number. This is the smoking gun that proves the paper market is broken. If the futures market was working properly, if COMEX could deliver silver reliably, no rational buyer would pay $69 for something they could get for $55 through the exchange. You'd buy the futures contract, stand for delivery, and get your silver at the lower price. That's how it's supposed to work. The fact that industrial buyers are choosing to pay $14 more per ounce, choosing to go directly to the mines, choosing to bypass the exchange entirely, tells you one thing. They don't believe COMEX can deliver. They would rather pay 30% more and guarantee they get metal than pay less and risk getting nothing. That is a vote of no confidence in the world's largest silver exchange. From the people who need silver most, the manufacturers, the tech companies, the defense contractors, the people whose factories shut down if they don't get silver. And think about what this means. If you're Samsung and you need silver for semiconductors, are you going to buy a COMEX futures contract and hope the vault has metal when it's time for delivery? When the vault is losing 20 million ounces a month? When the roll is failing? Or are you going to go directly to First Majestic and say, here's the premium, ship me the silver? We already know Samsung locked up 100% of the output from the La Parrilla silver mine through a direct prepayment deal. That was the first signal. Now Hecla and First Majestic's earnings are confirming it's not just Samsung, it's a pattern. Industrial buyers are going around the exchange, paying premiums to secure physical supply. And every ounce they buy directly is an ounce that never enters the COMEX system. The exchange is being drained from both ends. Deliveries pulling metal out the front door, and direct deals preventing new metal from coming in the back door. That's why the vault is collapsing, and that's why the collapse is accelerating. The more the vault drains, the less confidence buyers have in the exchange. The less confidence they have, the more they go direct. The more they go direct, the faster the vault drains. It's a death spiral, and it's already in motion. First Majestic also reported something I think is being overlooked. Their minting operation, First Mint, had record quarterly sales of $22.7 million, up from $9.1 million a year ago. That's their direct-to-consumer physical silver business. Record retail sales, even after a 46% crash. People are still buying physical silver. The crash didn't kill demand, it just created a temporary discount. And they announced they're doubling their dividend payout rate to 2% of net quarterly revenues starting Q1 2026. When a mining company triples its cash and doubles its dividend, that's not a company expecting lower silver prices. That's a company preparing for much higher ones. Now think about Q1 2026. Silver averaged around $90 to $100 in January before the crash. If First Majestic was getting a 26% premium on $55 silver, imagine what their realized price looks like on $90 silver or $100 silver. The Q1 earnings from these miners are going to blow the doors off. And every earnings report that shows a premium above COMEX is another nail in the coffin of paper price discovery. Now, let me show you what the U.S. government said today that ties this all together. Undersecretary of State Jacob Hellberg gave new quotes about the critical minerals price floor system. Quick context if you haven't been following this. On February 4th, Vice President Vance stood in front of representatives from 55 countries and announced that the U.S. is building a reference price system for critical minerals, including silver, a floor price. maintained by tariffs. The EU, Japan, and Mexico agreed. Trump launched Project Vault, a $12 billion strategic minerals reserve. I covered this in full detail in a recent video. Link in the description. Today, Helberg went further. He said they have developed a very, very sophisticated price floor system. And then he said this: "We are very excited about it because pricing is the key to unlocking private investment. Pricing is the key to unlocking private investment." Let that sentence sink in. The US government is saying out loud that the current price of critical minerals is too low, that the price needs to be higher, and that they've built a system to make it higher, so that mining companies will invest in new production and processing. A government official used the words, "very excited about a price floor for silver." When was the last time a government official was excited about making a commodity more expensive? That tells you everything about how serious this is. And I want you to think about the irony of what's happening. The bullion banks, the big commercial shorts on COMEX, they've been fighting to push silver prices down for months. They crashed at 46% on January 30th. They're trying to scare longs out of the market. And while they're doing that, the United States government is building a price floor to guarantee that silver prices stay high. The shorts are fighting against their own government, the same government that controls tariff policy, the same government that just launched a $12 billion strategic reserve. The shorts are on the wrong side of history and on the wrong side of their own country's stated policy. That's not a position I would want to be in. And look at the timing. This comes out while COMEX is draining at 20 million ounces per month, while two miners are reporting 26 to 30% premiums, while the March roll is failing at half speed. The government is building a floor under silver at the exact moment the physical market is proving it desperately needs one. The price floor is not a safety net. It's a launch pad. Now, I told you I'd give you 5 specific signals to watch over the next 5 trading days before first notice day. Here they are. First, the daily roll rate. If March open interest is not dropping by at least 6,000 contracts per day, the roll is behind schedule. Watch this number every day. I'll be covering it. Second, registered silver. If it drops below 85 million ounces before first notice day, a normal March delivery becomes nearly impossible. We're at 88 right now, 5 million ounces away from that line. Third, the March May spread. If backwardation deepens, meaning March starts trading at a bigger premium to May, it means urgency for immediate delivery is increasing. That's the market screaming for metal now. Fourth, margin hikes. If CME raises initial margin requirements on silver futures, that's the early warning that they see the problem, and they're trying to reduce open interest by making it more expensive to hold positions. And fifth, the eligible category. If eligible silver starts dropping alongside registered, it means even the silver that's not currently available for delivery is being pulled out of the system entirely. That would be the single most alarming signal for COMEX inventory. I'll be tracking all 5 of these daily. Subscribe so you don't miss the updates. Let me connect everything now, because separately these are interesting stories. Together, they tell you something that I think the financial media is completely missing. The vault is draining at 20 million ounces per month. It's gone from 200 million to 88 million. The roll is running at half speed. Backwardation confirms urgency. The delivery rate in February was 98%. January delivered 7 times the prior year. Two miners are both getting $69 for $55 silver. Industrial buyers are bypassing the exchange. Samsung is locking up entire mines. The US government is building a price floor because the current price is too low. In total, 2025 deliveries doubled over 2024. Every single one of these data points says the same thing. There's not enough silver. And the system that pretends there's enough silver is breaking down in real time. And I want to bring it home to you personally, because this isn't just about COMEX or futures traders or industrial buyers. If you hold physical silver, this data tells you your metal is worth more than the price on your screen. The real market is paying far above the paper price. Shanghai is paying even more. The government is building a floor to make sure it stays high. And the vaults that are supposed to have enough silver for everyone are running dry. If you're thinking about buying physical silver, this data tells you the window may be closing. When APMEX couldn't ship for a month after the January crash, that was a preview. If COMEX intervention triggers another price spike or another shortage, dealer delays will be even longer next time, because there's less silver in the system now than there was in January. And if you're watching this and thinking, surely someone will fix this, ask yourself who. The miners can't increase production fast enough. New mines take 7 to 10 years to build. The exchange can't manufacture silver. They can only change the rules around who gets what's left. And the government just told you they want prices higher. Nobody's coming to push prices down. Everyone with power wants them up. I want to be honest with you. I've been analyzing this daily for weeks. And every day I look for the counter argument. I want someone to show me the data that says this is fine, that the vault will refill, that the roll will catch up, that the premiums will disappear. Every day I look, and every day the data gets worse. Not sideways, not ambiguous, worse. The vault goes lower, the premiums go wider, the roll goes slower. At some point, you have to trust what the numbers are telling you. And here's where I stand personally. I think COMEX is heading towards some form of intervention before March is over. I think the $69 realized price from these miners is closer to the real value of silver than anything on a futures screen. And I think the government price floor announcement is the beginning of a permanent shift in how silver is priced globally. That's my read on the data. You can disagree, but that's what the numbers tell me. 5 trading days, 88 million ounces, a roll at half speed, a 98% delivery rate, 2 miners at $69, a government building a floor, and a chart that points to 0 by March 6th. You can raise margins, you can crash the price, you can change the rules of the exchange, you can offer cash premiums to convince people not to take delivery. But you cannot create silver that doesn't exist. You cannot refill a vault that's been draining for 5.5 months. You cannot unreport the earnings that 2 mining companies just filed showing they got paid 30% more than the exchange price. And you cannot convince industrial buyers to trust an exchange that is running out of the one thing it's supposed to deliver. The system is telling you something, every data point, every earnings report, every vault number, every delivery rate, every government statement. They're all saying the same thing, and at some point, the price on your screen will have to catch up with what the physical market already knows. This is my opinion, not financial advice. Do your own research, make your own decisions. But I have never seen this many data points all pointing in the same direction at the same time. The paper silver market is running out of time, and the physical market has already moved on without it. Drop a comment and tell me whether you think COMEX makes it through March without intervention. Yes or no? And tell me why. I'll pin the best responses from both sides. Share this video with one person who still thinks the silver price on their screen is real. Show them the vault chart. Show them the miner earnings. And ask them to explain how 2 different mining companies both got $69 for $55 silver. If you're not subscribed, hit that button now. 5 days until first notice day. I'm covering every single data point between now and February 27th. The vault numbers, the roll rate, the spreads, all of it, every day. Subscribe so you don't miss what happens next. This is the hidden economy. Stay sharp, stay stacking, and I'll see you tomorrow.